and gentlemen, Graeme Holm here, aka Australia's original money mentor, and it's an absolute pleasure as always each week to introduce you to the brilliant Dr. Andrew Wilson. I won't cover off his credentials. Most of you by now should know who he is and the amount of weight, his accreditations and his experience. He's definitely well versed as a talking head in the industry, and his knowledge, his degrees, his accreditation cover all of that. So let's not muck around. Good morning, Doc.
Yes, thank you for that, Graeme. And we've had an extraordinary big week in not just property, but in economics this week. Of course, it started off with our usual results from the weekend, and weekend auction markets are still looking pretty good. And we've certainly got a lot to talk about in terms of the budget and the forecasts for the budget, not just the macroeconomic forecasts, but the forecasts for new house building, new home building. Mm-hmm. And of course, we've just had fresh off the press. We still have a press, fresh off the press, the latest inflation numbers. And look, they're a little sobering, but we'll discuss that going forward.
Sounds like a plan. We might get you to bring up your data set, Doc, and away we go.
Thank you, Graeme. Yes, we'll look at the latest news in terms of news and views from my housing market. And I guess we could start off with the budget, Graeme. It's certainly got a lot of news headlines, as it should, of course. It's the budget. We have a November budget, which is, October-November budget, which is a little different, of course. But I think in terms of the housing market, we'll look at that firstly. There were some big announcements from the government in regard to their plans for new house building or new home building. Of course, we know that are we in the midst of a housing crisis? Some would say that. I guess we're certainly hearing headlines to that degree, of that nature, of rents going through the roof, vacancy rates the lowest we've ever seen, people having to choose units because they can't afford a house, and really no sign of improvement going forward. The only thing that's stopping rents rising is the fact that, in Sydney, 50% of the average income is now going towards a house rent. So you can only pay so much, and that's creating a ceiling for house rents, I think, everywhere, not just Sydney, and people are now shifting across the units. But the government's response, they have an aspirational target.
Aspirational target. Okay. Is that like if we don't get there and failed, it was just an aspiration?
Yeah, we were just aspiring to that. And of course, that's a bit like wishing and a hoping and a praying, but at the end of the day, a target is a target, and you should be held accountable for it. But even with that aspirational target, which let's describe what it is, Graeme, it's 1 million homes to be built over the 5 years from 2024 to the end of the decade. And it is supposed to target the areas of low vacancies and high rents. Well, that's just about everywhere, is it not? Certainly most capital cities. And I think that's another constraint, and we'll look at the constraints to achieving that target. And one of the constraints is the hardest part to get, or the hardest place to get, new dwellings approved and built is in the middle ring and inner ring suburbs of the capitals, and that's where the low vacancies and high rents certainly are.
I can't help myself, Doc. It's a funny number. If anybody's listened to us over the past 3 months, 6 months, I've heard you say multiple times, we're a good 1 million dwellings short in Australia. And by the time we built them, if we could build them, we'd need another 1 million homes.
Yeah, that's
right. Here they are with a target of 1 million homes.
That's right, Graeme, but over 5 years. And that's the problem. You see, at the moment, Graeme, so far this year, and there's been a lot of chat about looking back to see what we've built over the past 5 years, but we really can't look at that as a symbol of underlying, dwelling construction, because we've had a couple of factors, of course, going back a little further than 5 years. We had that apartment boom in Melbourne, Sydney and Brisbane, which was quite extraordinary. And then we've had a house building boom last year as a result of home builder. So we should be looking at what's happening now. And the market certainly has settled down. The new building market, new house building market has settled down this year. Currently, we're tracking at around about 15,000 approvals. Let's remember, these are building approvals so far this year per month. So that would give us 180,000 this year. which is around about the sort of normal underlying number that, we should be focusing on. So even at the levels at the moment, Graeme, we're not going to reach that 200,000 a year that the government is targeting. And let's remember, these are approvals. They're not completions. They're not houses or homes that have been finished. They're approvals. So that'll be lower than that 15,000. The approvals will be, or the completions will be lower than the 15,000 approvals. So even if we do miraculously, reach that target, we're unlikely to cover the new demand coming through, Graeme. And that comes firstly, of course, from migrants. And we're likely to get not just, resident migrants, but also student migrants at the rate of around 200,000 a year going forward, into the future. And notwithstanding any, sort of problems or issues we have with borders opening and closing. But, and of course, we have the local household formation, that has to be accounted for. People, locally, higher demand for housing as households are formed in Australia locally. So that wouldn't, that aspirational target wouldn't even cover new demand coming through, Graeme. And of course,
well, then, Doc, we've got to find builders that still currently hold a license, that haven't gone into liquidation or receivership, that can get tradesmen that are skilled and get supplies and materials.
That's right, Graeme. So even if, all things were hunky-dory and we were building our 200,000 a year, which we're not building anywhere near at the moment, we still have the issues confronting to get to that 200,000 a year. And that is high and rising building costs. We're going to quickly discuss the latest inflation data shortly, but that shows again that that's been a significant driver of inflation is new house costs. And that's all about the shortage of building materials and labour that's really constraining the building industry at the moment. And that, of course, is a big headwind for building, is the high cost of labour and materials. Developers are really finding it hard to, get off the ground with a lot of their developments because of those constraints that high building costs have at the moment. And certainly they're a significant factor in rising inflation. And it's not only the higher costs, Graeme, it's the usual, red tape, green tape barriers that we have to development in this country. And the big one is, of course, the not in my backyard lobby, which, at the local level, really does affect particularly development proposals in middle ring and inner suburban areas in the capital city markets. And that's another, all those factors are another reason why it will be a significant struggle, not just to get the 200,000 a year that's the aspirational target, but, to just get what we're doing at the moment, that 180,000. And as I said, if all things work their way out perfectly, wishing and a hoping and a praying, and we get those million homes, it's still unlikely to cover demand coming through, new demand coming through. So we're just going to sort of cancel out what things are.
It's only going to meet the requirements of migration.
That's right. And so that'll only mean, higher rents, lower vacancy rates and higher house prices. So
hang on, Doc. The media the last day or so, they're grabbing some RBA board meeting notes and blah, blah, blah. And we're hearing this verbal diarrhea again, 20% price house crashes. I mean, the data doesn't support it. If we can only aspire to create enough homes to house migrants each year, what about the existing housing crisis we have here? It just doesn't support a crash.
That's right. Great. Look, but we've heard this all before. And it's a rush. The backpedaling rush is a rush from those that do make these forecasts. And the government economists, the Treasury, the Reserve Bank, the banks have not really covered themselves in glory in terms of their history of accuracy with their prognostications regarding particularly the housing market. We're certainly seeing, and we'll look at it shortly, some improvements in the housing market. House prices are down nationally around about 4% so far this year. That's where they'll likely end up. So we've got a long, long way to go to get to those 20, 30% falls that have been predicted.
And we know statistically, Doc, after every slight correction or the market subdues, what happens in the subsequent years?
Well, of course, yep, that's right. And that's because, the scare campaigns that are run by, the media, which are just reflecting what, the talking heads are saying, they tend to, particularly in the short term, create pent-up demand because people just say, I better wait and see what's happening now. This sounds very scary. And the minute the air starts to clear, the minute it's revealed as being more rubbish, people who haven't been engaged in the market, they move into the market, and then that adds to what's already there and coming through. And as we mentioned, migration is a factor for Australian housing markets now with borders opening, and that just adds to demand. So we do see an uptick occurring, and it's a bit like that. It's a bit like the first law of physics. Every action has an equal and reaction, and maybe we're going to see that. But certainly the data is improving. But you'd think the media would get a little sick of the same old house price crash headlines that have been running since 2018, and all of them have proven to be complete nonsense. And if you sat on your hands in 2018 because of those predictions that were made that house prices were going to fall by 40%, if you look at how prices have grown in all the capital city markets since 2019, even with the declines this year, you're so far ahead, it's not funny, Well, I think
you presented this for us, Doc, on the weekend to our community, and to the net 4-year house price growth. You had Sydney up about 33%, Melbourne up 24%, Brisbane up 40%. Now, they were committing to or forecasting 40% drops. So Brisbane's 80% incorrect, Melbourne's 64% incorrect, and Sydney's about 73% off. Imagine having a 73% mistake in a forecast that some poor family, right, sat on there. Or, one of the statements that I had in there, get out while you can. I did a podcast on this with Beck because she's so irate about it. Get out while you can. This is verbatim. The slump we are currently in is more like falling off a cliff. And another one, it's coming. It's not if, but when.
Yeah.
I mean, come on. When are we going to be like, hey, this family bought a home here and an investment and doubled their net wealth in 4 years? Because that's the truth.
And going forward, Graeme, really, this is a global issue, particularly an issue in similar economies to Australia, such as the US, where they've run out of housing too, where rents are through the roof. We have a 3.5% unemployment rate. How in goodness name can you substantiate a house price crash when everybody's got a job who wants a job and wages are starting to rise again? So I think that, perhaps a little sobering for the media is that this is being ignored. And, people are getting on with business. It was interesting, Graeme, the latest data from the ABS home loan data, not surprisingly, over August showed an easing in overall home lending. But it was only a slight easing, but we actually saw first home buyers increase over all.
I think, Doc, were they up a good 6 or 7% for August?
That's 7%. That's right. So they didn't just sort of flatline. They were back in town. Their numbers are well below where they were a year ago. But I think first home buyers are thinking, well, firstly, this is a great time to buy even with higher interest rates because prices are lower.
And they don't have a trade.
Well, the other thing is they've got a job, they're making great money maybe. And, the phone never stops ringing because of, people wanting them to work for them. The other point is, why would you be in the rental market, right? They've got to get out of there ASAP, and that's, I think, another major, incentive for first home buyers. So first home buyers are just ignoring all the noise that's around. I'm surprised also that a lot of the data is becoming more positive. We'll look at the latest data shortly, Graeme, and there's no doubt that it looks like the Melbourne, Sydney and Brisbane markets, after a period of easing through winter, are now heading for the turn, which we may even see by year's end. But certainly improved.
You track the daily median asking prices, right, Doc? So that's a good indicator of whether people are discounting of what they think they should be asking for or actually increasing what they think they can get.
Well, we had a significant increase, Graeme, and perhaps we can look firstly before we look at the house.
Yeah,
price.
let's jump through it. Yeah, I don't want to get too ahead. I get excited. Sorry, Doc.
No, that's all right. But I'm just going to mention what the as we were speaking about the budgets and forecasts, I think it's instructive to see what the forecasts are from the budget in terms of the outlook. They're predicting wages growth skyrocketing to 3.75% by June next year. They've had a terrible record predicting wages growth, Graeme, so we really need to take that one with a grain of salt again. But even if it came true, that's a pretty good result for wage earners to have now coming from what is 2.6% up to a 3.75% increase. They're predicting unemployment to rise to 4.5% next year. Again, that's a pretty good number, Graeme, seriously. And I'm not sure we get high if we're going to get higher unemployment that we'd be getting, higher wages. So that's a little bit of a contrast in concepts, but nonetheless, even with a higher unemployment to 4.5%, that's still what I would consider to be a strong economy. Their inflation numbers a bit more on the mark at 7.75%, and then down to 5.75% in June next year. And they're still predicting GDP to rise by 1.5% next year, which is a lowish number. And I think they'll probably have underestimated Australia's potential for economic growth. And they're also saying no recessions for major global economies. I'm not sure they'll get that one right.
I don't know about that one, Doc. But the midpoint's interesting. Inflation, they think by next year, really starting to get back under control.
Well, that's right. And look, we're seeing, and let's talk about the inflation numbers while we're there, Graeme. The inflation numbers for the September quarter have just been released. The headline rate up by 7.3%. Clearly, inflation continues to be driven by surging house building costs, new house costs, and also furniture and furnishings. We actually saw a decline, which we have discussed here, in the price of oil. And we know that because at the Bowser, we've seen petrol prices falling over recent months. So that's not a surprise. But really, it was, house building costs that have dragged the annual figure up again, and now over 7%. But when we look at the quarterly data, Graeme, it was a bit more encouraging. Firstly, the quarterly CPI increased by 1.8%. Now, that was exactly the same as the June quarter, and it's below the March quarter where we saw a 2.1%. So just starting to get that sense that inflation is getting controlled. And of course, the building cost data has improved also, still rising strongly over the quarter. But as we've also discussed here, Graeme, the monthly data has certainly improved, although the latest monthly data wasn't great, but it's certainly improved compared to the quarterly data over June. So some reasonable prospects that we may be seeing the peak of inflation over the September quarter going forward. And as I said, with those numbers, those predictions, there still looks like a strong economy to me, mate. So we'll see how these pans out. And like I said, the budget forecasts really have been characterised as being, not that great,
unreliable
accuracy. So we spoke about, and I'll run through to the prices data, Graeme, perhaps as we spoke about what's happening with prices, and then we'll look at our auction markets.
Yeah, it's unfortunate, Doc, that all of these forecasts, no matter where they come from, they just don't seem to be, well, yours are, but the majority just don't seem to be reliable. I think, the clock's right twice a day, but these guys can't get it right once in 2-3 years.
And look, it's one thing when the data is supporting it to some degree. In other words, it's falling. But when the data's moving in the other direction, you ask yourself, well, why are you saying this? What is substantiating it?
There has to be an ulterior agenda, because you can't be claiming it in direct opposites. Like, you've got data going this way and then people saying, no, we're going to crash 20%. How?
Well, these are asking price. Well, that's right, Graeme. And, these are asking prices for, these are daily asking prices for the capitals.
Well, look at that. We're up 20K in Sydney in a week.
Right. And
We're up
Sydney
10K the week before, 20K this week. We're up 4K in Melbourne.
Yeah.
The data doesn't substantiate it.
And these daily numbers, of course, Graeme, can fluctuate. The snapshots are taken on a Monday, but it's a trend we look for. But you can clearly see there that the trend, particularly in Sydney, for both houses and units, is gradually improving. Similarly, Melbourne is holding at the levels of a month ago, and units are also holding. Brisbane again steady and at the peaks of a month ago, and house prices in Adelaide and unit prices are on the rise. So, there's nothing there that's showing a consistent downward trend in house price or asking house prices, which is what you would be seeing if there was a shakeout in the market occurring. In fact, the trends, and as I said, these are volatile weekly data, volatile weekly data is certainly looking upwards rather than downwards. And we shouldn't just look at single data points to sort of give our opinions here.
Yep.
And we can see when we look at the monthly data, and this is monthly home price data, house price data, we can see clearly there that the trend in declines is also falling on a month-to-month basis. Now, this is the month so far over October, but we can see there that Sydney is clearly on track now to record consecutive consecutive months where the decline in house prices is falling. And it's the same in Melbourne, the same in Brisbane, the same in Adelaide, and the same in Perth.
So just for people tuning in, Doc, on YouTube, obviously they might not understand that the graph. So you can see it coming down worse, and then it's actually coming back up from below the line. So that decline Doc's talking about, you can see on the screen, is actually getting less severe, back to base.
And it's not just a one-off, Graeme. There's a trend there. You can clearly see the trend, just as you could see the upward trend.
Melbourne's the same, Doc. Melbourne's the same. Brisbane's
and Melbourne's the same. They're all. Well, Adelaide's. Adelaide and Perth are at, I guess, at the neutral zone. They're between. They're just at zero. So there's no growth there. But after a severe shakeout in Sydney and Melbourne, particularly Sydney, that market's come back, and it's the old story with Sydney. Sydney leads the market up. It leads the market down, and then it brings markets back. And that's
it's by population, isn't it, Doc? I mean, Sydney and Melbourne really, the eastern seaboard of Australia really is the mass of the housing market.
And it's an undersupplied housing market, Graeme. Yeah. We know that. And in the midst of one of the strongest economies in our history, given that record low monthly unemployment rate, near record low unemployment rate, people have confidence. And we look at the latest retail sales data, people are still spending, Graeme. And the inflation data has shown that it's still all about, people buying goods and the shortages of the goods that are being bought, creating higher prices. We're not seeing it translate into services yet, the inflation data. And this shows that buyer sentiment is still positive. Consumer sentiment is still positive. As I mentioned before, first-home buyers have decided, we're not buying this. We're moving back into the market while prices are low, and we don't want to be caught in a position where rents are taking up 50 or 60% of our income, which means we can't save. And also maybe recognising that these markets will eventually turn again. So the monthly data is certainly supporting what we said in regard to the daily data that we take on a week. And if we just look back to our latest auction data, Graeme, I think that's also a positive, gives us a positive outlook for the market. We've been very bullish on our auction markets over spring so far. And the latest weekend data, and look, so we've gone from the week taken on a Monday to Monday. Then we've looked at the month. Now, this is the daily data. This is the real daily data, Graeme. This is telling us what's in the minds of buyers and sellers on a Saturday in terms of the weekend auction markets. This is a great forward indicator for housing market activity. We know that. We discuss this every week. So this is something that those that are connected to the housing market should always be looking for. Now, last weekend, Sydney auction numbers have been a little flat over the last couple of weekends, but the clearance rate again reached 65%. Sydney's really consolidating at the moment around 65%. Of course, we've discussed, Graeme, that 65% clearance rates are sort of the beginning of the neutral zone.
Yeah.
They're the area where buyers and sellers are sort of evenly matched.
Yep.
But once we start to get to 70% clearance rates, it really does start converting then back to a seller's market. In other words, there are more buyers than sellers, and that's where we start to see the upward growth in prices. So certainly Sydney's been hovering at or above that 65% mark over the recent weekends. This coming weekend in Sydney, Graeme, we're going to see more auctions. We should see well over 600 auctions in Sydney. So that'll be a good test for the market. But on the positives, it's actually good for buyers out there because they'll have more to choose from in a market that's certainly, reinvigorated itself since winter. Now, Melbourne had Super Saturday last weekend. The Melbourne market had one of its biggest days for auctions this year so far, over 1,000 auctions. And hey, Graeme, didn't miss a beat, mate. 6.3% clearance rate. Great stuff, Melbourne. Didn't worry about all those extra properties. 400 extra properties, nearly half as much again as the weekend before. Wow. And yet it produced a very solid 66% clearance rate. Of course, it was Super Saturday because it was the weekend before the Melbourne Cup long weekend holiday in Melbourne, and agents always avoid the clash with that weekend. So there'll be just a handful of auctions in Melbourne coming up as everybody focuses on the Cup. And unfortunately, I think they're going to be looking for their umbrellas again going down there. So shout out to Melbourne. But another good result there. Brisbane bounced back with a good result also. Adelaide the strongest as usual in terms of clearance rates. And Canberra showing some real signs of consolidating its recent recovery. So those auction markets, and when we look at the trends, Graeme, they tell us the story. You can see after that fade out through winter, the Sydney market trend is certainly up and about and rising. And trends are important because they give us the overall picture rather than just that weekend by weekend snapshot. Similarly, Melbourne, not quite as strong as Sydney, but Melbourne didn't fall as much as Sydney. So it's
still creeping its way up there. That trend looks pretty good.
Absolutely, Graeme. And that's the point, that it's been sort of the great survivor. It didn't dip away as much as particularly the Sydney market did through winter. And it's just kept on keeping on and is, recording, very solid clearance rates and moving out of that neutral zone. So it'll be interesting to see whether that's maintained after the Cup break, but certainly some good results for Melbourne. If we look at the Brisbane market, again, it's starting to look like it's picking up after a quiet winter period. Similarly, Adelaide back up amongst its highs, not as high as a year ago, but reviving. And as we mentioned, Canberra's also looking a lot better. And these are the monthly averages of or the monthly clearance rates, and with October up to date. So that's all positive news, but it's real data news, Graeme. I mean, this isn't, sort of based on whatever. And that's the point. We don't see any real justification of how these forecasts of significant house prices are arrived at. The house price crashes are arrived at. I mean, as we've mentioned before, the worst results we've had in terms of that year by year, December quarter to December quarter results in the modern era nationally was 5.5%. And that was in 2018.
And it was macro-prudential regulation and APRA, and we're putting rates up for it. But you know what's interesting, Doc? We've got a housing crisis now. Rents are through the roof. Properties are selling as soon as they're listed in a lot of areas. If we put rates up to try to slow down investors, if we have a housing crisis and rents are through the roof, and do you think they'd ever consider the opposite? Maybe there should be a discount for landlords. Maybe they should be getting a better deal if they reduce their rent. Like, we're going about it arse up. When we think it's too hot, we'll destroy the market. But when we think that we're in trouble and no one's got a roof over their head, we do nothing.
Yeah, that's right. And this is the political bizarro world we're in, because governments seem to regard investors, residential investors, as persona non grata. Let's get rid of them, right? All the regulators, let's get rid of these damn investors. Hello, we've got rents going through the roof. Hello, we've got record low vacancy rates. Hello, we got rid of investors. Why is this happening?
Hang on, we can't build enough homes.
Yes.
So let's do absolutely nothing for investors because we can't afford to do it. But let's not do anything to help a family put a roof over another family's head.
Well, look, and that's the point, of course, Graeme. Is exacerbating the issue with underbuilding or low supply. Is that the latest home loan data is showing investor lending falling. And I think some of that, and maybe this is an interesting insight, is because banks are again placing constraints on investor lending. Bring back the credit squeeze, the banks might be saying, which at the end of the day, really, governments who are wanting to improve supply should be telling the banks, hey, stay out of this, guys. We've got a big issue here, because if we end up with people sleeping in the streets as they do, in particularly the east coast of the US, we're in big trouble with the electorate, let me tell you. So, it's a great thing to have all those, risk-averse big banks, that only got 4 banks. But when they start interfering with the housing market and it's causing significant social dislocation, and it's, going to have a political, end game to it all, I think we've got to start thinking about having some action from the government in terms of just whether our banking system is serving Australia in the best interests of Australians. So, as I said, it was interesting that those investor numbers were falling. Is it the reintroduction of a credit squeeze from the banks who are nervous about their forecasts of house price crashes, therefore they don't want to be exposed to investors? And if so, and if they get it wrong again, is it just another indication that the big banks aren't acting in the interests of consumers generally? And they've got a responsibility to do that, Graeme, because let's face it, they are a protected species, mate.
Yeah, I wish they'd meet that obligation. But anyway, that's a whole nother conversation.
And an interesting one. So we've gone through all the data. It's been a big day today, of course, and this week, Graeme, with the budget and the aspirational targets, which we've discussed. And of course, inflation, although a big number, the signs are that actually might be the peak of the ball game. And perhaps, that might be the one thing that Treasury gets right or the budget gets right. No, they'll get more than that right. But certainly I think that, again, we mentioned Melbourne Cup Day, Graeme, and next week will be the traditional Melbourne Cup Day interest rate decision. So where will the Reserve Bank fall given this latest inflation data? Of course, we know the Commonwealth Bank has predicted there is only one more increase left in this cycle. Will it be the final increase this coming Melbourne Cup Day? And how high will they stay at the 0.25% that they increased it over for October, or will they go up by 0.5% because the inflation rate has increased? Again, another big week in property coming up to discuss, Graeme.
Absolutely, time will tell. Well, there you go, ladies and gentlemen, another amazing update with Doc Wilson for the week. And stay tuned, and we'll see you all next week. Thanks, Doc.
Thanks, Graeme.
Well, there we have it, ladies and gentlemen. Brilliant and informative from Doc Wilson, as always, and sometimes not too bad myself. Hopefully you found that extremely informative. And for those of you who are tuning in regularly, don't forget to check the show notes. And if you are looking for a bit more financial education and financial literacy, and you'd love to spend 2 days with people like myself and Doc Wilson and chartered accountants, etc., I encourage you to go to money-mentor.com.au, and I'd love for you to be able to use the discount code podcast1500. That's podcast1500, and you'd be able to spend 2 days with people like Doc and myself. That's usually $2,000. It'll be just $497. So have a look at the show notes, ladies and gentlemen. Look forward to seeing you soon.